If you're new here, welcome to Decoding Finance. Our goal is simple. Explain retirement taxes and personal finance in plain English so you can make smarter financial decisions. Now let's begin. One of the biggest surprises in retirement is discovering that your Social Security benefits may not be completely tax-free. Many retirees assume they've already paid for these benefits during decades of work, so naturally they expect the payments to come back tax-free. Unfortunately, that's not always how the tax rules work. Depending on your total retirement income, up to 85% of your Social Security benefits may become taxable. What determines this isn't just your Social Security check. The IRS looks at what's called your combined income, which includes retirement account withdrawals, pensions, investment income, and part of your Social Security benefits. Here's the problem. The income thresholds that trigger these taxes were created decades ago, and they were never adjusted for inflation. As a result, millions of middle-class retirees now pay taxes that were originally intended for much higher income households. Imagine a retiree receiving Social Security while taking withdrawals from a traditional IRA to cover living expenses. Those IRA withdrawals increase taxable income, which can cause a larger portion of Social Security to become taxable as well. Many retirees don't realize this until they file their tax return, and by then, the extra tax bill comes as an unpleasant surprise. The good news? With proper retirement income planning, many people can reduce or even minimize this tax. But first, you need to know it's there. The second surprise catches many retirees after age 73. For years, you were encouraged to save money in traditional IRAs and 401ks because of the tax advantages. But eventually, the IRS wants its share. That's where required minimum distributions, or RMDs, come in. Once you reach the required age, you're generally required to withdraw a minimum amount from your tax-deferred retirement accounts each year, even if you don't need the money. Those withdrawals are usually treated as taxable income. Here's why this matters. Imagine you've built a healthy retirement account over several decades. You may prefer to leave that money invested for future needs, or even for your family. But once RMDs begin, your flexibility becomes more limited. Larger withdrawals can increase your taxable income, potentially affecting other parts of your retirement plan as well. That's why many retirees are surprised when their tax bill rises, even though they're no longer working. The lesson is simple. Retirement isn't just about saving money, it's about planning how and when you'll withdraw it. Tax trap number 3. Higher income can increase Medicare costs. Now let's connect the dots. The same retirement withdrawals that increase your taxable income may also affect your Medicare premiums. Many retirees don't realize that Medicare premiums can be adjusted based on income. If your income exceeds certain limits, you could pay higher monthly premiums for Medicare coverage. This adjustment doesn't happen immediately. Instead, Medicare generally looks at your tax return from 2 years earlier. That means a large retirement account withdrawal today could increase your Medicare costs down the road. Imagine withdrawing extra money to help a family member, renovate your home, or make a major purchase. You may accomplish your goal today, but 2 years later, you could receive a notice showing higher Medicare premiums because your reported income increased. This surprises thousands of retirees every year. The important takeaway isn't to avoid withdrawals altogether. It's to understand how your withdrawal strategy can influence both your taxes and your healthcare costs. Sometimes, spreading withdrawals over multiple years, instead of taking one large distribution, can help reduce the impact. In the next section, we'll cover the 2 tax traps that many retirees never hear about, including one that can quietly increase the taxes on every additional dollar you withdraw. This next trap is one of the least understood parts of retirement taxes. Most people think, I'm in the 12% tax bracket, so every extra dollar I withdraw is taxed at 12%. Retirement doesn't always work that way. Here's why. When you withdraw additional money from a traditional IRA or 401k, that withdrawal may not only be taxable itself, it can also cause more of your Social Security benefits to become taxable. In other words, one decision can create multiple tax consequences. For example, imagine you withdraw an extra $10,000 from your retirement account for a home repair or family expense. That withdrawal increases your taxable income. It may also increase the taxable portion of your Social Security benefits. And if your income crosses certain thresholds, it could even affect your Medicare premiums in future years. The result? your actual tax cost may be much higher than you expected. Financial professionals sometimes refer to this as the tax torpedo, because several tax rules can work together at the same time. The good news is that this isn't something you have to fear. You simply need a withdrawal strategy that considers the bigger picture instead of looking at each account separately. A little planning today can help avoid expensive surprises later. Tax trap number 5. Missing your best tax planning window. This may be the most costly mistake of all, not because of a tax you pay, but because of an opportunity you never knew existed. For many retirees, there's a unique period between retirement and the age when required minimum distributions begin. During these years, your taxable income may be lower than it will ever be again. This can create valuable planning opportunities. For some retirees, it may be a good time to evaluate strategies like gradually moving money from traditional retirement accounts into Roth accounts, reviewing withdrawal plans, or coordinating income with a tax professional. The key point is this: once required minimum distributions begin, many of those planning options become more limited. Unfortunately, thousands of retirees spend these years doing nothing, not because they're careless, but because no one ever explained how important this window could be. By the time they realize it, the opportunity has already passed. Final thoughts. Retirement isn't just about building wealth. It's about keeping more of what you've already earned. The 5 tax traps we've discussed today are completely legal, but they often catch retirees by surprise simply because they're not widely understood. Let's quickly review. Your Social Security benefits may become partially taxable. Required minimum distributions can increase your taxable income. Higher income may also increase Medicare premiums. Multiple tax rules can work together, increasing your overall tax burden. Missing your low-income planning years may reduce future tax-saving opportunities. The good news? With proper planning, many retirees can better manage these challenges and make more informed financial decisions. If you're approaching retirement, or you're already retired, now is the perfect time to review your tax strategy with a qualified professional. A few smart decisions today could make a meaningful difference over the years ahead. If you found this video helpful, subscribe to Decoding Finance, give this video a thumbs up, and share it with someone who's planning for retirement. Thanks for watching, and I'll see you in the next video.